It's Brian Preston, the money guy.
Okay, here's a fun one. This is from Jared. On the Fidelity 401k website, let's just start right there. Congratulations for having a Fidelity 401k. They're a really great provider, have really great options out there. He goes, I have 3 options for contributions. Before tax, Roth, and after tax. What is the purpose of after tax within a 401k? Should someone not maxing out 401k be using the after tax?
So here's what's funny. Every time I hear after tax now, because of our show on these type of accounts, I think of Apex Predator, because we talked about all the different savings accounts. You got your tax deferred, which is your traditional 401k. We've got your tax-free, which are your Roth accounts. And then we talked about that there's actually an Apex Predator out there. And it used to be like, I think people thought Great Whites, but then we found out that there's something even above Great Whites because they're being hunted a little bit. So it's after tax are used for what's called mega Roth conversion strategies. And these things are super powerful, but I'm going to let Bo give you the details, but here's the word of caution or disclaimer I'll put. Remember to respect the financial order of operations is because you're probably not going to hit the mega Roth conversion after tax opportunity unless you're doing a lot of other things right in your life financially first.
Yeah, so pre-tax 401k contributions obviously go in pre-tax. Roth contributions go in after tax, but they grow tax-free. Well, those 2 types of contributions are limited to $19,500 if you're just looking in the year 2020, or there's a catch-up if you're over 50. However, what a lot of people don't realize is that the after-tax contributions are not capped at the $19,500. You can actually contribute to the after-tax account above and beyond $19,500. So for folks who would like to have some other type of tax-deferred savings, you can use the after-tax to do that. You don't get a deduction when the dollars go in, but all of the earnings do grow tax deferred. So it's kind of a little bit different than a brokerage account. It's like a mix of a brokerage account and a 401k. So that's good in and of itself. You put in the after-tax dollars and the earnings can grow tax deferred. What Brian is alluding to is another iteration of that where if your plan allows in-service rollovers or in-service conversions, you can actually convert those after-tax dollars in your 401k to Roth, and then not only will the contributions grow tax-free, but the earnings will grow tax-free also. It's a mechanism where you can fill up your Roth bucket in or your 401k bucket all the way up to $57,000 a year, and potentially $20,000, $30,000 of that can be Roth contributions.
I do want to give one word of caution, though, because realize the government, when Bo mentions that $57,000, that is a cap on what you can put in both in your contributions as well as your employer contributions. And what you don't want to be is so aggressive with your funding that you squeeze out your year-end employer contributions, because that's that free money that your employer is giving you for working there and kind of letting you know how much they appreciate you being part of their success. So you do have to balance this. It gets complicated. And that's why we say when you're looking at an advanced strategy like this, it's one of those definitely measure twice, cut once. So we call this advanced. I mean, we're giving you enough information to make you dangerous, but it is something that you might want to consider taking the relationship to the next level. If you are at the point that you can fund the full $57,000 a year, you might need somebody in your corner to make sure that you're protected from what you just don't know.
Yep. You can go to aboundwealth.com, moneyguy.com, work with us, and we're happy to take a look at that.